Hello, YouTube. My name is Justin, and this weekend we're going to try to find out what it would take for this head and shoulders pattern to break bearish and for us to have that continuation lower to confirm we're not only in a bearish pattern, but in a bear market for 2022. Finally, we're also going to look at what it would take for the bulls to convince me that maybe we found a short-term bottom, maybe find some relief and move higher. So here we have a head and shoulders pattern. As I noted in the other video with the key dates for this week, I talked about how there is going to be a lot of focus on the Fed. So what the Fed has to say is likely going to move the markets. So if we're aware of the technical pattern and the potential for the news, that should be able to give us an edge for this week. Moving forward here, the first thing we want to look at is what we talked about last weekend, where we mentioned that the 200 DMA and the 50 weekly moving average are those key areas. And we're already closing below the 200, and we got a kiss of death earlier in the week. And then we're also closing below that 50 weekly moving average. So the easiest thing to try to summarize where we're going to go this next week is, are we going to get a bounce at all? And if we do, what's going to happen on that 50 DMA at roughly 438? If we kiss it and reject off of it, that is terrible. We're already below it. We're also going to re-summarize a slide from last weekend regarding Jesse Livermore, where I want to focus on a couple of slides here. A couple of notes that are already highlighted. Livermore liked trading in stocks that were moving in a trend, and he avoided ranging markets. When prices approached a key pivotal point, he waited to see how they reacted. We are right at that point right now. We are on the 50 weekly moving average, and almost every major ETF is closing below the 50. Almost everyone, as we're going to review in the last part of this video. And I'm making a mental note. I forgot to have one thing open, so I'm just going to get that prepared for right now so that I can be a little bit faster as I transition to the next part. There we go. All right, moving forward back to here. So what it would take for me to signal a short-term bottom would be a gap down pump up. Generally speaking, when we get a gap down pump up, that is the potential for relief. Relief turns into reversal when we not only take out the relative lows, but the relative highs. Remembering what happened last January, we got a gap down pump up, and that's what started this reversal. So we gap down, flushed, and put in a hammer by the end of the day. If we're going to get geopolitical tension over the weekend, that is what I am going to be looking for. We're closed on Monday. So the feedback loop back to the S&P and back to the US markets might be providing us with that gap down pump up. Moving forward to the heat map for this week, we can see that there's only a couple of pockets of green, right? Select tech, boring tech, consumer defensives, and then also restaurants. So this is interesting. When we look at year to date, again, we got financials, we got energy, we got aerospace and defensive, and we got a little bit of consumer defensive. So this is what I would see if people were going towards inflation, going towards higher rates, and going towards value. Moving forward, there's a couple of earnings this week, but to be honest, there's nothing really left, which I think is not going to provide all the clues we already have from the market in terms of where we're going to go, what sectors matter, and what the trends are. Moving forward to the key dates. In February, there are only a few. On Sunday, the Olympics wrap up. There is a holiday Monday for the US for President's Day, and I think it's called Family Day in Canada. On Thursday, there is the potential for a Putin meeting. That is the one that is already scheduled. I don't know if it's going to happen, but if it does, it is scheduled for that Thursday. On Friday, we got PCE, which is the Fed's favorite inflation measure, coming out on Friday. We also have the Fed Monetary Policy Report. So by Friday, we're going to know what's happening with the geopolitics and also with the Fed. As we mentioned in the other video, on February 2nd, we also have Jerome Powell testifying. We've got the blackout period for the Fed starting on the 8th. On the 16th, we have the FOMC meeting. And on the Friday, we got OPEX. Moving forward to why we would be bullish or bearish. And again, if you're enjoying the video at any time, I would encourage you to smash the thumbs up and drop me a comment, please and thank you. Why bull? Well, the bottom's in. Peacocks and geopolitics. I went over this in the other video. I would encourage you to watch that one, which we will leave at the end of this video if you're curious, or check the description and it should be there. So I'm not going to talk about exactly what that means here. It just means that if the lows in January hold, it means the bottom's in. And I think that we have potential to dial back some of the rhetoric. Bearish, we got the wheels in motion. We are at the peak cycle and we have uncertainty. Same thing from last week. Geopolitical uncertainty, Fed uncertainty, that took us lower. Now we're hearing up to 9 Fed rate hikes. I think that's a little bit silly, and I don't know if that's going to really materialize. We can dial that back a little bit. Surprises, geopolitics into the first half of the week will be the most important. Then we got the Fed report on Friday, and then we got bearish put flow on SPY and QQQ. So if the bulls have anything left in the tank, I mentioned last week that we did not quite dive down to the 420s area that I was looking for us to confirm that the selling was going to overwhelm the buyers. So if we get a gap down pump up and a bullish reaction, I am going to get more bullish. We have to be above that 50 EMA, and it always matters on how we set the gap down and how we react to it. I'm just watching for the potential here, keyword being potential. So for the bulls, what they need to do is save a few key charts, including Apple, Tesla, and Nvda, because the rest of the trillion-dollar companies are all below their 50 weekly. We're going to look at that shortly here. So that is the bull case for this week. The trillion-dollar staples are going to hold up, and they're going to plunge the market. In terms of the bears, we already know these targets. These are the bear market targets, not all necessarily for this year. But if we are truly in a bear market, the 430 area should lead to a test at 400, and we should ultimately make our way down towards 380s or 370s, which is where I am hearing commentary that the Jerome Powell put is. So we got to be roughly 20% off the highs for Jerome to come in with that sweet, sweet sugar. Moving forward here for the bears, all the bears got to do is control the charts and move them lower. That's it. The bears are currently in short-term control. A lot of charts are closing below their 50 weekly moving average. So base case right now is that we're bear. Yeah, the base case right now is that we're bearish. So let's move forward here one more time before we jump into the charts to understand what Jesse Livermore told us last week. So as the context and the pretext for the charts, again, just look at here. Jesse liked trading stocks that were moving in a trend. And I just told you the trend is down. So what does that mean? Be cautious if you're bullish. And if we get more feedback, please, please, please take your head out of the sand and come to the dark side. He avoided ranging markets. So right now we know we're still roughly range bound, but we are getting bear breaks by closing below the 50 weekly. When prices approached a key pivotal point, he waited to see how they reacted. So that's what we want to do here. And what he also mentioned is that what he needs to do is be fast at reacting after the pattern materializes. I think I deleted one of the slides by accident. So now we're going to look and see how they react to the key pivotal points. I call those apexes. And when we see the early feedback, we have to pull the trigger. So let's move forward and look at some of these charts. We got SPY coming up first. All right. So first thing we're going to look at here is going to be a quarterly chart. And let me see if I can find it here. Here we go. This is a quarterly chart, which means that every candle represents 3 months worth of data. If you're not sure what's going on here, it's an uptrend. So a 428 to roughly 430 is acted as a very strong basing area where we moved all the way up. We price discovered higher. We ultimately engulfed the bar, and now we got a bearish engulfing pattern here. So the question is, can we actually hold up for this the rest of this quarter? It is currently February 19th as I'm recording this video. The end of the quarter is on March 31st, post FOMC meeting. So if we can just hold the lows, right? Hold the door, hold the line. That gives us the potential to open up into the next quarter here, right at that pivotal point. Because we're looking at a very high time frame chart, this basically tells us that if these lows hold, we are maybe not going to move dramatically lower. Looking here at the monthly chart, now we can just note that that is why I have this big green line right here at 428. It's the base from that quarterly chart. Can't hold that. We're probably heading down to that 384, which is going to be a 20% drop off the all-time highs. Looking at a shorter time frame like on the weekly chart here, we note that we're still going up, lost our upper uptrend. We got our blue one here. It's the absolute going off the absolute bottom, touching our point here. And we got about 431 is our 431 is our uptrend for next week. So if we print a lower low, that signifies that we're below the 50. We're no longer going up. We are going down, and we have to be mindful of that. Looking at the daily chart, we see here that again we got another triangle or a pennant. And again, the apex or the pivotal point, as Jesse Livermore calls it, is right here. Happens to land on the 4th of February, which is when just after Jerome gives his semi-annual testimony. Let's keep that in mind because As we look at QQQ, it's also going to really matter here. On SPY, the reason why this chart matters is because what we have here is a funnel lower signified by the blue lines. And if we zoom in really close, as we look to here, 4 o'clock on Tuesday is going to be 431. So what this tells me is that if we get a gap down pump up, manage to close above 431 by the close on Tuesday, this means that we're still inside the funnel. If we fade and do not hold 431 by next week, that tells me that we are below the 50 weekly, below the 200 daily, and breaking bearish on the hourly, which means that every pattern is now bullish, and all we have to hold on to is that 428 area. Let's shift gears here and have a look at QQQ. So now we're going to look at QQQ, and then we're going to look at a couple of very important trillion-dollar companies just to make sure we understand what the potential is here. So looking here at our monthly chart for QQQ, we can note that, again, green line is roughly 338, and it's just above this monthly low for January. So if that can hold, the bulls potentially have some traction. Looking here at the weekly chart, clearly going down, signified by these blue lines after we stopped going up. So we were going up, we started going sideways, and now we're going down. That is the definition of a reversal. Looking at the daily chart, what do we have here? Well, we got a couple of key rejections and a funnel lower. What's really important here is that this apex at 338, which we noted on the higher time frame, also lines up here with February 4th. When is that? Ah, that's right. It's 2 days after Jerome. That's right. It is 2 days after Jerome. So now we are already below all the averages, 50 weekly, 200 daily on QQQ and SPY. Now let's have a look at a couple of ETFs really fast. Let's look here at XLF. And all I want to look at here are going to be the weekly charts and whether we are above or below the 50 weekly. XLF is pointing up, still above the 50. QQQ, below, kiss of death, right? Not quite able to touch it, only the real bodies, and rejected. Looking at the Dow, DIA, below. That's a rejection. 3 upper wicks or 3 inverted hammers. Then we got the Russell, IWM, way below the 50 weekly. Next one up, XLV. XLV, again, riding its uptrend, but it is what? It is below the 50 weekly. Moving forward to our next one, we got RSP. RSP is throttling right on the 50. Equal weight, S&P 500 is right on the 50, only a couple of cents above. We look at NYSE, and again, you can pause the video. You can see the green lines and red lines are going to tell you green means support, red means resistance. Looking here at NYSE, or the New York Stock Exchange, which includes 2,000 stocks, we are what? Below the 50. All right, XLE, way above the 50, set for a golden cross. So what are the only ones holding up right now? XLF and XLE. If that's a sign of a healthy market for you, buy the dip. Get excited. Otherwise, please, please, please be mindful. And finally, I got ARK here. ARK is throttling on this green line below the 50 weekly. It is now 50%, 60% off its highs. This chart looks terrible. And on Monday or tomorrow, I will be uploading a video specifically on ARK, and I think we might be peaking out. So those are the ETFs. As you can note, the 200 daily and 50 weekly are not being held by most of these charts. Let's move forward to the next section here. We got QQQ and the trillion-dollar companies. So what does that mean? QQQ, looking at the weekly, what does it tell us? We're below the 50. So as I noted at the beginning of the video, what I want to see to confirm that we're going to be going lower for a fresh leg lower is going to be the underlying stocks, which make up the QQQ and a heavier weighting, also break bearish. Those include Apple. So Apple here is the king. It is owned by Warren Buffett. It is resilient, and it is the biggest stock in the S&P. So what does that mean? For the market to truly fail, Apple has to fail. Looking here at the chart, we are way above the 50. It's sitting at about 150. But if we lose 165 and 157 area, that should be a magnet. 150 is a nice big round number. And I would suspect that if we get weakness at 165, we're probably going to dive down to 157 and potentially down to 150. So as of right now, Apple is the strongest chart out of these trillion-dollar companies, period. Moving forward to the next one here, we got Microsoft, second biggest stock inside the entire market, roughly 2.6 trillion, I think. Looking here, what are we? We're below the 50. Oh no, that's not good. Looking at Goog, very big company as well. What do we got? A rejection off the red line, and we are what? below the 50 weekly moving average. That is a yellow line if you're not sure. Moving forward to the next one, we have got Amazon. Look at Amazon, solid downtrend, rejecting off the red line, and what? Below the 50 weekly. Also looking here at Facebook. Facebook has been destroyed. It is way, way, way below the 50 and also way below the 200. It is not going up. This is not a nice chart. What else have we got here for the trillion-dollar companies? We've got Tesla. So moving forward to Tesla, here we can see that this is the chart that I used when I was calling out for my price target to 1,000 for Tesla. And what I would note here is that it's still trending up. It's still above the yellow line right here. We can see that yellow line, and it is in a funnel lower. So right now, Tesla is actually the second strongest chart that I can see out of these trillion-dollar companies. Final one here is going to be Nvda. So again, Nvidia is worth about $650 billion. It is just over Facebook's value of roughly $630. It's not quite a trillion-dollar company, but it is a barometer for chips. Chips lead tech, tech lead SPY. We can note here that we got a double inverted hammer rejecting off of roughly 268 or the red line. We're still above the 50. So to make it simple, what do we need? Well, we need for these charts to what? Break below the 50 weekly moving average on a weekly closing basis. That would signify that the S&P is weak, likely going lower. QQQ should be below those January lows. And for me, there is no doubt that we are in a bear market. So hopefully that's clear. Now let's look at a couple of options to finish the story off and get you prepared for this next week. So you now know all the key levels that we talked about during our bear targets, and you also know all the levels we looked at on the chart. So now the question is, let's look at the strikes, which are most important here. I'm just going to go through these really fast because I don't want the video to be super long. So on Monday, we got 435 as max pain. We can see a couple of calls, couple of puts, but 435 would be max pain for me on Monday. There's a lot of volume here at 430. Let's see if it converts to open interest. Into Wednesday, we got 430 versus 440. It's quite muted. Looking at Friday, here is where it gets more spicy. We can see that there are more pink lines on the right side, which means there are more puts which capture my attention. 440, 435, and 430 puts for Friday. Those numbers are very important, as we noted on the charts, and there is bearish continuation. I would also note that Friday, beyond the 16s, there is aggressive volume and open interest all the way down to 420 and below. There is 30,000 in open interest at 435, 20,000 at 430, 30,000 at 425, 26,000 at 420. There is more than 30, 40, 50, 60, 80,000 in volume at each one of these strikes. And what are they? They're worth dollars. These are big dollar amounts. Moving forward here to the February-March monthly, we got 440, 435, and 430 put spread continuation. And again, there's a little bit of naked calls here at 440, but it's pretty bare. I would also note here that we got, beyond the 16s, we got massive flow all the way down to 380, right? Look at those juicy numbers. Pause the video if you want to see each detail. What I want to focus on here is that you can see here at 400 put for, again, March, which is the date we talked about earlier. We got 27,000 in volume and 120,000 in open interest. And as we look forward to the very top of the slide here, hopefully you can see it, at 380, there is 100,000 in volume. So what was that level we talked about on the bear market targets? It was 380s. That would be 20% off the all-time highs. And this looks perfectly like a massive put spread for me. So one more time, if we are below on Friday, we have continuation and motivation to drive us lower all the way through to March 18th. We're going to look at two more indicators here, which are new. I've got the VIX here and the put call for S&P 500. Just look at the number here, 1.88. That means that for every call purchase, there are 1.88 puts. Looking here on the PCSP chart, we are closing at a record level. We have nearly 100%ed off of last week's low. Pretty incredible. What does that mean? People are gobbling up puts like you wouldn't believe, as we noted on the options chains. Looking here to QQQ, we got 343 to 340 put spread. On Wednesday, it is muted, looks just like SPY in terms of being a little bit out of the money. And then Friday, we've got the same thing as SPY again, 345, 340, 355 puts. Mostly volume, a little bit of open interest here at 340. Moving forward to the QQQ monthly chart, we have 65,000, 95,000, and 52,000 sitting at 345, 340, and 335. What is that? That is continuation. As we look here too, beyond the 16s, I am seeing some big numbers here. This is quite bearish for me. What it tells me is that we've got a straddle at 360. We see big open interest. We see volume as well. That signifies that this is a straddle to me. And the 360 puts are worth $21. The calls are worth about $3. So this number over here for the puts is dramatic at 112,000. We also have about 148,000 sitting here at 350, which for me signifies a put spread. So we've got a 360 straddle, a 360, 350 put spread. And then we have got these fat volume and open interest way down. So what I'm noting here is that it goes all the way down to about 300. So again, what do we note on the charts on QQQ? If we lose the low, we're likely going quite a bit down. So at 330, 325, 320, 315, and 310, there is juicy flow. Notably here at 315, there's nearly 200,000 in open interest. Our break even on that's going to be roughly 310. So those are the levels that signify everything we looked at before. And again, a head and shoulders pattern is bearish until proven otherwise. All we got to do is fall below that 428 area we noted on the quarterly chart and on the monthly chart. And then taking out the relative low at roughly 420 means that we're likely going down to 400, if not back down to back down to 380. Thank you very much for watching. And we're going to have another video queued up if you want to see all of the key catalysts and dates which could move the market this next week. Thank you for watching, and I would really appreciate a thumbs up and you drop me a comment for your thoughts on the market this coming week. Thank you.